Welcome to the Daily Update. This is Being Prepared Friday, October 14th, where we'll look at the action in the market today and then see how things look for Monday, October 17th. And it was another one of those crazy days. It looked like we were going to start off on a positive note and try to build on the back of the gains that we saw on Thursday, but no. Not long after the open, everything reversed course and started going down. So we're kind of back at the same point where we were on Wednesday. The market's gone up, it's gone down, only to come right back where we started. So we're going in circles right now, figuratively. So what happened at the open? We did have a gap higher right at the open, but selling then took prices negative and down to the daily pivot at 36.16. As the day went on, we dropped below the daily pivot and then just kind of drifted lower and lower and lower going into the close, so that we ended up closing at the low. We ended up being down 2.37% on above average volume. The technicals, they're still negative overall. Even with the strong update that we saw on Thursday, that didn't really do anything other than give us some hope and possibly look at some of our setups and signals that they might generate something. But with Friday's decline, that's all kind of gone off the table now. Inflation and interest rates are still the main concern with the markets, but they're having problems in the UK again. There's kind of switching back and forth between what they said would happen on Thursday. They changed that a little bit on Friday. I guess they fired their finance minister or something. The current prime minister, who hasn't been there very long, may be running into a lot of trouble, and there's backtracking and going back and forth, and that's a real mess, which it's like, okay, that could bleed over into the EU, that could bleed over into the US. It's not like we belonged to them in the past and broke away and became our own country or anything, but you know, we kind of look to them not only as an ally now that we're friends, but we can also look to them for what are they doing financially and how does that compare to what's happening in the US, because this can have a real contagion effect or a wave if things really turn bad there, and could really disrupt an already pretty delicate situation. We do start seeing more earnings coming out in the coming week. A lot of big companies will be coming out with those. They can really set the tone depending on what the company is, what sector they're in. Sometimes that can bleed through into the actual indexes. And then any Fed speak that we may get. So what are some comments? Since Wednesday, the S&P has made a round trip back to nowhere. It went up to 3,700, and that is overhead resistance. Well, it's kind of left in the dust now because we turned and went down the other way. Just to give you an idea, Wednesday's close was 35.7703. Friday's close was 35.8307, a difference of 6 points, which is really nothing with the S&P. So we virtually were on a treadmill and came right back to where we were a couple of days ago on a closing basis. The 20-day moving averages, which are right at about that 3,700 level, they are acting as resistance. We got just about up to that and then came down, and I'll show you that chart. And then here's the UK part where their prime minister reversed course from yesterday and said that, you remember that corporate tax increase that I wanted to do? Well, we're not going to do that. Well, on Friday, I guess we are going to do that. And that we're going to deliver a medium-term fiscal plan on Halloween, October 31st. And so we're hearing different things coming out of the UK right now, and that's causing some roller coaster action, not only in their bond market called gilts, but that also bleeds over into the US markets. Then the Bank of England, it ended its emergency liquidity support for the gilt or their bonds. And this leaves some real uncertainty. Are they going to meet over the weekend? Is something going to happen? Are they going to come up with a plan after this? What's that going to do to Monday's open? We still have a number of yield curves that are inverted here in the US, and they've been inverted for quite a while. Sentiment with the down day is now drifting back to more extreme fear. And the big report that came out was retail sales, and they were unchanged on a month over month basis. They expected it to be up 0.2%. So that came in a little weaker than expected. If you take out automobiles in that whole thing, retail sales were up 0.1%, where they expected them to be unchanged. So that was a little stronger than expected. So the market had kind of been using this as a bit of a catalyst, at least at the open, but then everything just went south after that. Import prices were down 1.2% on a month over month basis, and they were down 0.4% if you take out fuel. Export prices were down 0.8% month over month, and if you take out agricultural products, they were down 0.9%. So we're seeing this typical trend of a weakening economy. Now, the import-export prices, they're not real market movers, but that just feeds into this scenario that the economy could be weakening. And then the preliminary consumer sentiment report came out. It rose to 59.8, which is still pretty pathetic. It's actually a little higher than what they expected at 58.6. The last time we had this report, we had 58.6. So it was up just a little bit compared to last month. Just to give you an idea, a year ago, this report was at 71.7, which is not a gangbuster reading, but certainly a lot better than it is right now. So people are just not happy. Business inventories were up 0.8%, a little less than expected at 0.9%. And then last time we had this report, they were up 0.5%. Our trend is still negative and getting stronger. The ADX, everything is kind of mixed up right now with these really choppy days. The ADX is still above 20. Our bias now is back to a more solid negative. I kept it at negative even after Thursday's advance because I was kind of afraid of something happening on Friday like it did. And then our momentum continues to be negative when we look at the last 2, 3, 4, 5, 6 trading days. Man, this is kind of an interesting thing I ran across just on the lighter side. Do we have a World Series indicator here? It just says every time the Philadelphia Phillies win the World Series, they're in the playoffs right now. Does this signal an economic downturn? But history says yes. Of course, the person here is a huge Phillies fan, so they say no. But when did the Phillies win the World Series? Well, 1929, 1930, those were kind of bad years in America. That was a big stock market crash and then the Depression. 1980, not a real gangbuster year economically. 2008, great financial crisis. Is this just a coincidence? Yes. There's all kinds of different indicators that we can use. They have the Super Bowl indicator. They have how high or low are the hemlines in women's skirts. Some people use the planets and how they all line up with each other. There's all kinds of, if it moves, if it seems to be somewhat coincidental to the stock market, they apply it. The presidential, who wins the presidency? But people just like to do those kinds of things because the stock market is like one of those conspiracy theories where you have an event A and event B, and there's a chasm between the two, and people want to fill that chasm with something, even if it's ludicrous, even if it's nonsensical. And they like to do that with the stock market. They want to find a reason for the stock market to go up or down. And so they come up with all these crazy things to try to compare to whether the stock market's going to go up or down or not, where we just look at charts and just go with what they're telling us at the time. All right, let's go back and talk about the day's session. We're back down a little bit further with our fear and greed index down to 21, where we had been at 24, and it's starting to tip over just a little bit with the down day. Here is the preliminary reading of the consumer sentiment, where that's the blue line, where it did get all the way down to 50, and it's coming back up slightly. It's at 58.6. And then we compare that to the 2-year yield. Well, that's just been going up and up and up. So even though this is declining a little bit, these are still very, very far apart from each other, where they have a tendency to move in the same direction, and they have a tendency, even though they're on different scales, to not get that far apart from each other. We also had the latest reading of active asset managers. They're back down now. They're extreme negative currently. This was probably after the big down Friday, which is pretty much where we're still at right now. So they're more negative. We can possibly use this as a contrary indicator with so much pessimism. And then here's the individual investor survey. Now, I showed a different chart in yesterday's video. This is also getting down to the extreme negative reading, which we often use as a contrarian indicator when it's extreme. So we're seeing a lot of sentiment really coming together of being pessimistic. However, on this next chart, and you can pause this and read through all these crazy little things. To me, the takeaway from this is the headline. It says only 20% of signposts or signals triggered right now, where usually 80% trigger before a market bottom. So somebody did a spreadsheet here and looked at all these different indicators, which usually show when we've bottomed out. And so far, 20% have triggered, where usually it's 80%. All right. Now, also looking at how inflation is working these days, we have sticky inflation, which is the red line. That's the inflation that doesn't change. It doesn't go real wild. Okay. And this is usually around the core services. It has really been going up. And that's what we feel over and over again. Where the blue line, this is flexible inflation, meaning core goods. It has been declining. So they're still a lot higher than they were before. So this is just telling us that inflation continues to go up, which you probably already knew anyway. Here's another look at a long-term chart of tech. This is tech relative to the S&P 500 price basis. And this is one of the charts that I go through in the intermarket analysis video, where have we topped? Did we get to a real extreme reading here? All right. And then are we starting to come back down? Okay. What will that mean? Because we've really been declining in 2022, because this goes all the way back to the 1920s. There's a chart that I showed yesterday that suggests that maybe the non-tech issues, more of the traditional type of investments, will do better going forward. We don't know that for sure, but that's what some people are saying, where they still think that tech may have a long way to fall from where it's at after its very large climb. Here's another one, the cumulative change in real S&P, that's taking inflation into account, and real profits taking inflation into account. Typically, when the blue is above the black, that's bad. And when the blue is below the black, that's good. Well, the blue is above the black right now. They're calling this the central bank bubble. Before that, it was the everything bubble. Well, now that the Fed is really at the center of everything, they're blaming all of this on the Fed. But this is just taking a very long look back to, 1955, and suggesting that we're still very much in a bubble environment right now, and this could produce further problems. Then the Eurozone validations. This is the combined PE ratio using the trailing 12 months, which looks back, and then the forward PE, and then the PE ratio over it's like an average of 10 years. And it's just showing how it's really coming down when you take all of this together. So, and the green line here is the long-term, the dashed line is the long-term average. And we're getting to kind of an extreme negative reading at -1 standard deviation. So this could suggest that in the Eurozone, in Europe, stocks are becoming relatively inexpensive on a historical basis. Try telling that to the people in the UK right now. And then this is another thing where the dollar, which continues to show strength, it's pegged to Hong Kong stocks, show regime change. Okay. Are we going to see more unsettling things happening in Hong Kong? Well, here, this is what we call the Asian currency crisis. And this is where we saw a bottom and then it came up. Here's the dot-com boom and bust. Here's the great financial crisis low. We're calling this the energy crisis low here. And a lot of times when these things happen, are they going to change some kind of regime, their government, or something like that? in Hong Kong when comparing it to the Hang Seng index? I don't know. Keep in tune with the news and we'll see what happens. Then here's Goldman Sachs Prime Services hedge fund leverage. Now, this is another thing. If we start falling, if what Jamie Dimon actually says that we could fall another 20, 30% from here, that's going to put a lot of hedge funds into trouble because they use a lot of leverage, and that can really spark some problems. That's what really led to the beginning of the great financial crisis, were some hedge funds that were over leveraged with instruments that they thought were going to act one way and ended up acting the opposite way. You want to see an interesting movie? It's called Margin Call. And it actually came out right about at the beginning. I believe it was at the beginning of the financial crisis. And they didn't really know what was going to happen at that time, but it kind of foretold what was going on. But if you look at the light blue line here, this is the gross exposure, okay, overall on this side, and then the net exposure over here, the dark green line. And this is just suggesting that maybe there could be some problems if we really start to go lower from here. All right. And if you start hearing about hedge funds going out of business or can't meet margin calls or things like that, because these folks do use a lot of leverage and they're usually planning on the market to go one way. When it goes the opposite way, boom, they could really run into trouble with all of that. Because with hedge funds, they may be big money, but they're not considered the smart money. So they're following the markets just like you and I are. They think they have an edge on what they do, but they're really just big piles of money doing things that often reacts the same way as the crowd does. All right, here's the latest reading with the RightX. I just can't believe this. You could do the opposite of what this chart says and probably do better. This was after Thursday, or this is when this was updated. That's when we had the big up day. So we have a big down day. Everybody gets into the bearish funds and then the market shoots up. So then they get into the bullish funds and they're doing exactly the wrong thing at the wrong time. And that's one of the real drawbacks with using these mutual funds, which I've used for years because they have enhanced and inverse mutual funds where you can play both sides. But a lot of these folks, they react to what's already happened, and that's how they make their decisions. We need to look at things that are happening right now, develop scenarios, and then watch them play out, and then put our plan into action that's going in the direction that our evidence is suggesting. But these poor folks are just getting whipsawed back and forth. All right, during the day, we saw growth down pretty heavily. Even in Thursday's update, growth really underperformed value, at least on the large cap level. Mid caps growth also really underperformed, as well as on the small caps. So, but our VIX just kind of went flat on a closing basis. It spiked up a little bit, but ended up just being virtually unchanged from Thursday's session. The VIX of the VIX is also declining, which just shows the VIX is slowing down right now. The Ulcer Index is turning back up a little bit after coming down to the moving average. I would put this higher right now. I think that's more representative of the fear that's really going on in the market. So this one's kind of an outlier as far as measuring sentiment. That's my personal take on this. We're down 25.64. Isn't that a song? 25 or 6 to 4. Great song put out by Chicago since the all-time high. And then the equity put call ratio actually dropped on a down day, and it's dropping a little bit on our 5-period chart. Here are the pivot points, which have been posted on the YouTube channel for Monday's session. And they're going to be really wide because we saw another big swing in the daily session. Just to look back at some short-term fib levels, this was where we thought we set the low. We broke down below that, came above it, had the really nice up day. Well, then we came right back down. So we're still right around at the lower level of not only where we were Wednesday, but where we ended, just about where we ended a week ago Friday. And so right now that support is holding. It's holding on by a thread, but it's still holding right now. Then this is also showing how we dropped down to the 50% retracement. And this is where the market found support in Thursday's session. It came down to this level. It saw 50% retracement from the COVID low to the all-time high. And then boom, we just shot up out of that. Well, we're right back down to this. We're in threat of coming back down to this again. If we do fall from here, is this going to hold again? Or are we going to see things fall through and actually go below it? We saw massive support at this level the first time. Can it happen again if it happens? Then here's the weekly chart, again, showing how we came down to the 50% retracement, and we're right back up to the underside of the 200-week moving average. So it's kind of a loose definition here, but this moving average is still providing, well, we're a little bit below it, but we're almost right on top of it as well. You could say that it's providing some support, as is the 50% retracement level. So these are two really big areas. If we fall below that and close below it, things could get really ugly, no matter how oversold we think the market is. Or is this going to hold up? And then we see some real support out of this that could produce some of the positive scenarios that potentially might happen. We're still down at the underside of the midpoint of the trend channel. Our sectors, all the sectors were down, with discretionary leading the way lower. Energy had a bad day. Everything had a bad day. Healthcare was down the least. And energy is still having the best looking technical analysis chart at 98.8, with real estate down in the single digits. Communications finally rising a little bit. It's at 13.2. Still pretty bleak, but better than it was in single digits. And here it's just showing, even though energy has fallen back, it's still up almost 40% since the all-time high. And then utilities have actually dropped into third place since the all-time high. And then all the other sectors, with communication in last place. And this is just an update of the different indexes since the S&P made that all-time high, coming up to almost a year ago now. Technical alerts started off really positive. Ooh, yeah, it looked like we were just going to town. We had a BPI cross above 20. That didn't last very long. The staples had a BPI above 30. The NASDAQ went above 10.7. The S&P got just barely above 3,700. And the financial sector, which has been doing a little better lately, it had a BPI across 20 and the healthcare across 30. Then everything changed and went in the toilet, where the NASDAQ was at 10.6, 10.5, 10.4. The NASDAQ ended up closing, the S&P closed below 3,600. The Dow went below 30,000. Started off with a lot of promise, ended in kind of a nightmare. So right now, with all that's being said and done, it's the Dow that's in first place. It actually led the way higher on Thursday and didn't really lead as much going down. Mid caps are in second place at 58.5. Small caps in third place. The S&P's in fourth place. And our caboose is the Qs, or the NASDAQ 100, at 18.1. Here's our intraday chart, where we did gap up and it looked like, okay, we might really be onto something here. Well, that lasted all of about 20 minutes before we started coming down. We went negative, shot all the way down to the pivot. That tried to act as support for a while, but then we fell below that, drifted sideways, and just kind of went down. We never made it down to S1 because the pivot points were so far apart based on Thursday's range. So it just was not a good day for the market. Looking at our trend, the ADX is now picking up some steam, even though the red line is declining and the green line is advancing, but it's still going higher overall. The red line is on top, so it is negative. Our Arun is kind of flattening out, but still looking kind of extreme negative when you look at the oscillator. Breadth, we had a really powerful up day on Thursday and a really powerful down day on Friday. So that's really wreaking havoc on our advanced decline line based on price and volume. And our advanced decline ratios also showing some weakness. The new highs, new lows, they're kind of hanging in there. Look at the down day we had, but we didn't see an expansion of new lows. They all happened on Thursday when we had the negative open. So this is showing that internally things are holding up a little bit better. But if we really break to the downside, expect this new low line to just be very, very long. And if somehow we break out to the upside, expect these green lines to actually start to show some improvement. Accumulation distribution showing weakness on a declining moving average. Short term, we may have overdone it on Friday. We went extreme positive on Thursday. Well, extreme negative on Friday with our advanced decline ratio. You think the market's a little jittery right now? Here's the 20-period moving average. We came right up to both of them, the exponential and the simple. That acted as overhead resistance, and then we came down. Rate of change going back just in Friday's session, we overdid it to the upside on Thursday, then we overdid it to the downside on Friday. Stoch RSI showing weakness. Williams percent R declining. Force index still showing some weakness, not really a big change there. This could be something positive, but we've been led astray by this indicator. The Swindlin trading oscillator still advanced based on price and volume, even with the down day. Just keep an eye on this. Mclaren oscillator is declining. Our moving average study is declining with the 20, 50, and 200. With the 50 and 200 tried to get out of extreme negative territory, but they're right back in it. Stochastics are negative in the short term. They're still trying to go higher in the intermediate term and floundering negative in the longer term. So we're seeing a real mix right there. The rate of change going back 50 periods is still extreme negative. The Sean trend meter is right on the border of extreme negative. The PMO still is negative, but if you look at the bottom one, you see where it just might be getting ready to cross positive based on volume. Sometimes these lead the PMO. Then our PMO study, declining with those PMOs that are rising, a little blip down with the buy signals, and pretty much flat with those that are above zero. The Chaikin oscillator, declining. Chaikin money flow, declining. Volume picked up a little bit, but is still tending to drop off in average. Vortex, seeing a decline in selling and advance in buying, but the red line is still on top, so it's negative. The summation index based on price is extreme negative, and we're trying to turn up based on volume. Kind of interesting. Sometimes when volume turns up before, that can be a leading indicator. Not always, but we're also extreme negative with volume as well. We're seeing a mishmash with our oscillators. The slope is still going up. The MACD is just bouncing. It doesn't know what to do. And the KST is flat to trying to turn up, where the TRIX is still negative, the PMO is negative, and the TSI is just kind of floundering around its moving average. So there's no uniformity here. Here's the BPI, where it did actually shoot up a little bit. And then because we were right where prices were before, it didn't really go down with the other prices. And then our ease of movement showing a little bit of improvement. Ultimate oscillator negative. Money flow index actually showing some improvement. The boom indicator starting to get extreme negative when you compare it to the 50-period moving average, and we're still down negative with the 200-day moving average comparison. TTM squeeze is still trying to suggest that things are getting a little bit better, but we're just not seeing it in price. Balance of power showed a slight decline. And now, after triggering all these crazy signals all over the place, the CMB is just all mixed up. Technically, this would be a sell signal because it crossed below a line, in this case, the red line. Then a confirmation of that would be if it crosses below the green line. Looking on a trend basis, we're actually showing some improvement with the Heikin Ashi with an open candle. We're still negative with the Kegi, even though the red line's going up. The Renko is still negative. Excuse me. 3-line break showing some improvement because we were just here at these prices on Thursday. We actually showed some improvement with the point and figure chart. No signal, but we drew in some X's. All of this came right at the open. Our trading systems, we're back to negative with the Elder Impulse for the S&P and the SPY. We're still negative with the SAR. We're still deep purple with the go, no go. So all of that's negative there. Our moving average study, longer term, we're declining with the 50, 150, and 200. Rate of change, we're getting down to extreme negative. We've been there for a little bit of time now. Special K starting to get to an extreme negative reading, but it looks like it might want to turn up, but it's going to take a long time for this to come back and cross over the moving average. Looking at the broad market, we're back to neutral with the diamonds. That's the Dow. It's been holding up a little better the last few days, and we did drop below the pivot level on the Dow. The Qs are back to negative and back down to where we were just a few days ago. Didn't quite get down to the low where we opened on Thursday, but we're down to this level currently. The Vixen, it actually declined on a closing basis, and we see kind of a doji pattern here on the bar chart. The NASDAQ still holding up a little bit better now. The mid caps also holding up a little bit better, but below the daily or below the pivot point. And the Wilshire also back down to where we were before. You could say we broke down to new support here, but we're kind of in areas where we were not very long ago. Dow theory showing how the Dow's been declining, the transports have been declining, and the utilities have been a lot straighter line going down. The dollar, it was up again since everything else was down, so it's at 113.20 currently. The dollar and the S&P are having a much more stronger inverse relationship now. Gold continues to go down after they were sure it was going to the moon. Silver continues to fall. Oil has been falling. It's down to 85.61 now. The correlation between the S&P and oil, when we're in this blue line to red line area, I count that as neutral. So we are neutral right now, but also moving down to possibly moving in inverse directions. Looking at bonds, they still continue to fall with the bond ETF, and we're breaking down well below the COVID lows with the World Bond Index. Our yield curves, no change here. The 10 to the 5, the 30 to the 5, the 10 to the 2, all still inverted. We have not gone inverted yet, but we get ever so close with the 10 to the 3 month. And we're seeing interest rates really going up. This is the 10-year yield where we've gone above 4%. But when you look at it, it's the 2-year that's giving you the best yield currently, followed by the 5-year. And then you've got the 10-year and the 30-year kind of kissing down here, but everything is going up overall. Our correlation, stocks and bonds, pretty strong relationship of going in the same direction. Pretty strong inverse correlation between the S&P and the 2-year yield. When you look at the S&P and the 10-year yield, also pretty strong negative or inverse correlation. The tech sector to the 10-year yield, also opposite directions. So just a quick update, even though these are pretty much not on the table right now, we're seeing some weakness with our 19-day exponential moving average based on price. We're back down to this red line, and we're showing some weakness based on volume. The stocks above their 200-day moving average also showing some weakness after giving us an extreme reading. The 50-period study is also showing some weakness for the S&P, the mid caps, and the small caps. Our 10-day average of highs and lows also, it's going up a little bit because this is 10 days. So it's a little more sane in how it reacts, but it's still trying to show a bit of improvement. When you take the 5-period and look at the broad market of highs and lows, we're coming back down. If we see much more weakness, it could come down and generate another signal. And then our equity put call ratio, after setting that spike, it really hasn't been doing all that much. The VIX didn't really move as much as you would think it would, or the equity put call ratio didn't move as much with the down day. Small caps also holding up, but dropped below the pivot point. And they're underperforming just slightly when compared to the S&P, the small caps. But when we look at this, we're seeing a little bit of a spike here, which might give some support to the S&P itself when we look at the ratio. Our sector rotation, not doing very good. I'm going to keep following these unless we start to make a new low. If we break this low set back in May, when I first saw this phenomenon happening, if we go down below that, we'll have to take these off completely. The same thing with these other ratios, if they continue to fall and drop below the low point, because they're still hanging in there, but barely. Then our S&P to utilities ratio, this is still holding up pretty good because utilities are really struggling. This sometimes can give some support to the S&P. So that's still giving us some hope. We don't know if this is a spike or not because the 2-year yield just keeps going up and up and up. The staples also had a weak day, but compared to the S&P, they're starting to get back up here and may take out this spike and create a new spike. And our Copic curve, we're still trying to work off a signal that was generated from that, but it really hasn't happened yet. And our bottom fisher is still giving us a signal, and which does pick direction, but we're just not seeing follow through based on price. So what's our outlook for Monday? The technicals are negative, but we're at support still. The support long term, and from last Friday and where we were last Wednesday, we have the Empire State Manufacturing Index, which is New York, not a major report, but New York is kind of major. So, but it probably won't move the markets. We've got the whole list of geopolitical events. The UK is kind of at the forefront right now, seeing what they're going to do. Of course, Russia, Ukraine, that is a nasty situation that could get even nastier. Inflation and interest rates, that's what the markets are really concerned with. We might get some kind of Fed speak and going back and forth. There's just a lot of negative things. So we're going with the down scenario because of all the things that I mentioned. And then the technicals are negative, but so far support is holding, even though I forgot to hit the space bar there. The technicals are negative right now, so we can't really go with the up scenario. Our possible positive scenarios, some of them are starting to show weakness. There's still a few areas of hope, but we really can't latch onto those. The technicals are not looking good right now. And sideways, we can't really go with that because we're still above 20 with the ADX, and it is strengthening with the red line on top. So our conclusion, S&P is negative and at support. That's about as good as you can come to right now. Short-term negative at support, intermediate negative at support, long-term, you could say we're at support and we're kind of extreme negative on that rate of change chart, but we're still well below the 200-day simple moving average. So thank you. As I record this, it is Saturday. The Seattle Mariners will be playing at least one more game in Seattle. And if they lose, it'll be the end of their season. If they win, they'll live to play again on Sunday. So have a great weekend. And I will talk to you in the weekly video and in the intermarket analysis video.